Listen, I want you to picture something. A Monday morning in August of 2025. A kitchen table in a ranch house in Albuquerque, New Mexico. His name is Walter. He is 67 years old. He retired 2 years ago after 31 years as a civil engineer for a state infrastructure department. He has a traditional IRA with $580,000 in it. He has a taxable brokerage account at Fidelity with $210,000. He has a money market account with $88,000. And he has Social Security waiting. His projected benefit at 67, his full retirement age, is $3,100 per month. At 70, it climbs to $3,844 per month. Walter read an article in 2022 that said delaying Social Security to 70 produces the maximum lifetime benefit for healthy retirees. The article had a chart. The chart showed the break-even point at age 82 and a half. Walter is in good health. He expects to live past 82 and a half. He decided to delay his Social Security benefits. He is using the 3 accounts to fund his retirement in the meantime. He is pulling $52,000 per year from the traditional IRA. He is drawing down the money market account for irregular expenses. The Fidelity account is mostly untouched, compounding quietly. Walter thinks he is being patient. Walter thinks he is being strategic. Walter's financial planner, the one with the quarterly review meeting and the laminated retirement income chart, has never asked Walter a specific question. In the year that Social Security starts, when the first $46,128 annual benefit joins the income picture, what happens when 3 accounts that have been funding Walter's retirement in a Social Security vacuum suddenly share a tax return with the provisional income formula under Internal Revenue Code Section 86? What happens is a tax event that Walter never modeled, that the article never mentioned, and that the laminated chart did not include. What happens is that the $52,000 IRA distribution that cost Walter $8,320 in federal tax in 2025 will cost him approximately $16,000 in federal tax in 2028 when Social Security starts, on the same withdrawal amount, at the same stated bracket. Because Social Security activated a phantom multiplier inside the tax code that effectively raises the marginal rate on every dollar of IRA income above the provisional income threshold from 22% to 40.7%. And if Walter delays long enough that his 3 accounts are significantly depleted before he files, the damage compounds in a second direction, because the accounts he is draining are the same accounts that could have funded a Roth conversion strategy during the window he spent waiting. Every year, Walter delays Social Security while pulling from the traditional IRA without converting. He is simultaneously draining the account that should have been converted, missing the conversion window that closes when Social Security starts and the provisional income machine activates, and building a larger Social Security benefit that will generate a larger provisional income contribution when it does start, further amplifying the cascade. That is the claim timing trap. Not the question of whether to delay or claim early. The question of what the 3 accounts look like when the filing date arrives, and whether they have been configured to survive the provisional income activation without generating a tax rate Walter never signed up for. That is what we are covering today. We are going to model exactly what happens to 3 specific account types when Social Security starts with each one in its default configuration. We are going to show the tax math in real dollars. We are going to name the threshold, the multiplier, the bracket interaction, and the IRMAA cascade that follows. And then we are going to walk through the claim timing and account configuration strategy that the financial press consistently fails to connect, because the claiming age question and the account structure question are covered in separate articles by separate writers who never model them simultaneously. Smash the like button right now. The algorithm buries content that connects Social Security claiming strategy to retirement account structure in the same analysis, because the financial services industry profits from managing the accounts, and the Social Security Administration profits from the delayed filing. And neither institution has an incentive to show you what happens when the 2 decisions interact. Every like breaks the suppression. Hit it now. Subscribe. Flip the bell. Join the archive. The suits in legal want me to say this is not financial advice. Fine. This is not financial advice. This is a forensic examination. This is a forensic examination of how the provisional income formula under Internal Revenue Code Section 86 interacts with 3 retirement account types, and what the account configuration in the years before filing determines about the tax rate for the rest of retirement. Consult a fee-only fiduciary who models both the claiming decision and the account structure simultaneously. What I can do is show you the math. Let me start with the provisional income mechanism, because everything that follows depends on understanding it precisely. Internal Revenue Code Section 86 defines provisional income as adjusted gross income plus tax-exempt interest plus 1/2 of Social Security benefits received during the year. That combined figure is measured against 2 thresholds that have not been adjusted for inflation since 1983 and 1993. For married filing jointly, if provisional income is below $32,000, none of Social Security is taxable. It generates $4,224 in interest income per year. That interest is ordinary income appearing on the 1099-INT. Above $44,000, up to 85% is taxable as ordinary income. For a single filer, the thresholds are $25,000 and $34,000. Now here is the interaction that destroys the standard claiming age analysis. For every dollar of income above the $44,000 upper threshold, the retiree generates $1.85 of taxable income. The original dollar plus 85 cents of Social Security being dragged into the taxable column, compared to $2,180 in federal tax alone during the delay period on the same withdrawal. This phantom surcharge operates silently inside the tax return. It does not appear on any single line of the 1040. It is the mathematical consequence of the interaction between the adjusted gross income line and the Social Security benefits worksheets embedded in the IRS instructions, and it applies to every dollar of income from the 3 accounts that Walter has been drawing from during the delay period, the moment those accounts share a tax year with a Social Security benefit. Walter is 67. He has been delaying for 2 years. He has 3 years remaining before he reaches 70. 3 years that determine what the tax rate looks like for the next 20 years of his retirement. 3 years during which he will continue pulling from the traditional IRA, the brokerage account, and the money market to fund his retirement. 3 years during which the Roth conversion window is open and the provisional income machine is dormant. Let me now show you what each of the 3 accounts does to the tax picture. Account 1. The traditional IRA draining at $52,000 per year during the delay period without Roth conversion. Walter is pulling $52,000 annually from the traditional IRA to fund his living expenses during the 3 years before he files at 70. He is not converting any of that to Roth. He is simply taking taxable distributions and spending them. He is not converting any of that to Roth. He is simply taking taxable distributions and spending them. His current taxable income during the delay period, before any deductions, is $52,000. His standard deduction for married filing jointly in 2025 is approximately $30,200. His taxable income is approximately $21,800. His federal tax is approximately $2,180. His effective rate is 4.2%. Walter feels comfortable. Walter is not planning. In 2028, Social Security starts. Walter receives $46,128 per year, $3,844 per month, for claiming at 70. Half of that, $23,064, enters the provisional income formula. His adjusted gross income from the IRA is still $52,000. His provisional income is $52,000 plus $23,064, equaling $75,064. His provisional income is $52,000 plus $23,064, equaling $75,064. He is $31,064 above the $44,000 upper threshold. At the 85% inclusion rate, $26,404 of his Social Security benefit becomes taxable ordinary income. He is $31,064 above the $44,000 upper threshold. At the 85% inclusion rate, his total gross income on the 1040 is $52,000 plus $26,404, equaling $78,404. His total gross income on the 1040 is $52,000 plus $26,404, equaling $78,404. After the standard deduction, his taxable income is approximately $47,804. After the standard deduction, his taxable income is approximately $47,804. He is firmly in the 22% federal bracket. His federal tax is approximately $5,780. New Mexico state income tax at approximately 5.9% on this income level adds another $2,820. Total federal and state tax, approximately $8,600 on a $52,000 IRA distribution. His combined tax burden in 2028 is $6,420 higher than in 2025, not because his bracket changed, but because Social Security activated the provisional income cascade and reclassified $26,404 of income into taxable ordinary income. And the damage compounds annually from this point forward because the IRA continues to generate RMDs. At age 73, the required minimum distribution forces additional ordinary income into the calculation, stacking on top of the Social Security benefit, pushing Walter into the 24% bracket and triggering IRMAA Medicare premium surcharges 2 years after the income event. The IRMA surcharge operates on a 2-year lookback. A high-income year in 2028 generates elevated premiums in 2030. The IRS built the 2-year delay specifically so the cause and effect cannot be seen on adjacent lines of the same tax return. Combined conversion tax, approximately $10,800 per year. Total conversion tax paid, $32,400. His taxable income is $30,000. His conversion income is taxed at the 12% and 22% brackets. Efficient. His taxable income is $30,000. His conversion income is taxed at the 12% and 22% brackets. Efficient. Over 3 years, Walter moves $180,000 from the traditional IRA into the Roth. The traditional IRA balance declines from $580,000 to approximately $400,000. This is the repositioning, because the Roth provides additional income tax-free. His provisional income is $53,064. He is $9,064 above the $44,000 threshold instead of $31,064. His SS inclusion is only $7,704. His total taxable income after the standard deduction is approximately $15,768. His federal tax is $1,577. His total taxable income after the standard deduction is approximately $15,768. His federal tax is $1,577. The break-even on the conversion cost is approximately 8 years. Every year after the break-even, the lower tax rate compounds into permanent savings that accumulate across retirement and across the inherited Roth IRA that his beneficiaries receive tax-free. Account 2. The taxable brokerage account generating dividend income during the delay period without repositioning. Walter's $210,000 Fidelity account holds a mix of equity index funds and individual dividend-paying stocks. The blended annual dividend yield is 2.1%, generating $4,410. Those are qualified dividends taxed at 15%. In 2028, when Social Security starts, those $4,410 of dividends enter the provisional income formula. Walter's actual combined tax on the $4,410 dividend is $1,487. His effective rate is 33.7%, not 15%. The dividends generate $3,749 of additional Social Security ordinary income at 22%, which is $825 in tax. The difference is the Social Security phantom multiplier operating silently through the provisional income calculation. Walter's actual combined tax on the $4,410 dividend is $1,487. His effective rate is 33.7%, not 15%. Tax-managed equity funds generate appreciation through price growth rather than annual income events. Appreciation is not recognized until sold. Appreciation is recognized at a time of Walter's choosing, in a year when provisional income is low. During the delay period, Walter can systematically sell high dividend positions and replace them with low dividend equivalents. The second intervention is systematic gain harvesting at the 0% federal rate. For married filing jointly, this applies up to $94,050. The second intervention is systematic gain harvesting at the 0% federal rate. For married filing jointly, this applies up to $94,050. Walter has $72,250 of headroom. He can reset the cost basis of those positions without paying $1 of federal capital gains tax. This reduces the embedded gain that would otherwise generate taxable income and Social Security cascade in post-filing years. Account 3. The money market and CD portfolio generating taxable interest income. Walter has $88,000 in a money market account earning approximately 4.8% annually in 2025. It generates $4,224 in interest income per year. That interest is ordinary income appearing on the 1099-INT. Every dollar of that interest feeds the provisional income formula. During the delay period, the $4,224 is manageable. In 2028, the interest joins the provisional stack. Above the threshold, it generates $7,814 of total income effect. The tax is $1,719. The restructuring involves two options. First is the MYGA, which allows interest to accumulate without generating annual 1099-INT income. Walter thought he was paying $929. He is paying $1,719. The effective rate on interest is 40.9%. The yield is crushed. The interest accrues tax deferred and is only taxable when distributed. During accumulation, it stays off the provisional income formula. Repositioning $60,000 from the money market into an MYGA removes $2,880 of annual interest from the formula. This reduces the cascade. Second option, short-duration Treasury securities held inside the traditional IRA. This keeps the interest inside a tax-deferred wrapper. The interest accrues deferred and enters the taxable calculation only when distributed, at a time and amount of Walter's choosing. Now let me give you the geographic dimension. State tax treatment varies significantly. In Texas, there is no state income tax. The 22% federal bracket produces a 40.7% effective marginal rate. Better, but still punishing. The conversion break-even in Texas arrives slightly later than in New Mexico, because the conversion tax paid is lower. Annual savings are also lower. The conversion break-even in Texas arrives slightly later than in New Mexico, because the conversion tax paid is lower. Annual savings are also lower. Now let me give you the geographic dimension. State tax treatment varies significantly. The California retiree has the strongest possible incentive to execute the Roth conversion during the delay period. Every dollar moved escapes a 55% cascade. Converting at 31.3% to avoid 57.5% is an exchange ratio of 1.84 to 1. Delaying the conversion costs double. Strategic choice is clear. In California, the state income tax rate reaches 9.3%. The combined cascade produces an effective rate approaching 57 cents per dollar. High stakes. In Florida, there is no state income tax on any retirement income. The most favorable cost environment available. Federal cascade still applies. The MYGA repositioning in Florida simply escapes federal taxation during accumulation. It's an effective federal tax shield. Now let me give you the 5-step action sequence. What Walter is doing right now. Step 1. Calculate the provisional income threshold crossing for the planned filing date. Quantify the crossing amount. That defines the problem. Step 2. Execute the Roth conversion ladder. Stay clear of IRMAA thresholds using the 2-year lookback. A controlled conversion is sufficient. Step 3. Reposition the taxable brokerage dividend yield downward. Replace with total return. Harvest gains at the 0% federal rate now. Reset that basis. Step 4. Reposition the money market and CD balance into an MYGA or IRA fixed income. Stop the 1099-INT leaks into the provisional formula. Step 5. Model the final provisional income calculation for the filing year. Determine if one more year of delay is worth the conversion opportunity. Save this video to your private library right now. Hit the bookmark. Label the playlist Retirement Survival. These are not separate questions. The claiming age determines when the machine activates. The account structure determines how much damage it does. They are the same question. The standard financial press treats these as separate decisions. They are not separate. The year SS starts is the year the machine turns on. Walter has 3 years. The window does not stay open indefinitely. Delay without conversion is a missed opportunity. Compound damage is real. Subscribe if you have not. Flip the bell. Comment with your age and traditional IRA balance. We calculate the window together in the comments. I read every one. Subscribe if you have not. Flip the bell. Comment with your age and traditional IRA balance. We calculate the window together in the comments. I read every one. The SSA wants you to delay for the 8% increase. They don't model what the accounts look like when you file. That is your responsibility. This archive supports you. The maximum Social Security benefit and the minimum tax rate are not automatically the same answer. Sometimes they are. Sometimes configuring the accounts is the priority. The only way to know is to run both calculations simultaneously, with the same model, on the same spreadsheet, with the same assumptions. Comprehensive. The only way to know is to run both calculations simultaneously with the same model, on the same spreadsheet, with the same assumptions. Comprehensive. That is not a 30-minute conversation at the quarterly review. That is a dedicated planning session with a fee-only fiduciary. Get the combined answer. That is not a 30-minute conversation at the quarterly review. That is a dedicated planning session with a fee-only fiduciary. Get the combined answer. In 2028, the interest joins the provisional stack. Above the threshold, it generates $7,814 of total income effect. The tax is $1,719. The Walter character smiling confidently as a warm sun rises over a ranch house, hopeful in warm colors. A 2D collage of financial success icons including Roth, Shield, and Savings Jar. Vibrant and positive. Final 2D title card. Your financial future is in your hands. Bright blue background, clean typography.